All right, let's go. So, there's a general strategy overview, and fair warning, I haven't used PowerPoint since grade school, so that's what you're getting. That's what you're getting. All right, so what is MarketSpy? It's pretty basic. It's an indicator package, but that's just what it is at its face value, because it also contains 5 strategies that are to be used with the indicators. And the indicator package itself has a lot more context when you look at it with those strategies in mind. So it's a set of 5 strategies to enter and exit the market. And I think that's another important point, is knowing when you're exiting the market. It's something that should be planned before you even enter a position, right? And that's something that CR stresses a lot in our live streams. So, a comprehensive and dynamic indicator package, which the 5 strategies rely upon. And it's a discipline that you must learn in order to effectively sign your contract with the market. This is something that CR talks about quite a bit. Signing your contract with the market. It's also something that Mark Douglas goes into pretty heavily. If any of you guys have read his book, Trading in the Zone, or learning, Thinking Like a Professional Trader. I watch those at least once a week. You need a kind of a constant reminder that trading is about being successful over a set of trades, not expecting each trade to be a success. And this is another one that I think is pretty important: a reimagining of traditional candlestick charts into a visual system. So there's a lot going on with the MarketSpy package, and it's got a lot of indicators rolled up into one, and it's easy to get lost in it if you don't really know what you're looking at, and if you're kind of picking things out or picking it apart or looking at it as a bunch of separate things. But you really have to zoom out at it and look at it as one entity that you're using these 5 strategies for. All right, so next I'm trying to delineate what separates MarketSpy from other traders. What is MarketSpy? So means that you're a trader is willing to take the time to understand a reinterpretation of the candlestick charts into this visual system. Otherwise, it's just going to be indicator spaghetti to you. You're just going to be looking at it, and you're not really sure what you're looking at. It's going to be too much information, and when the brain receives too much complex information, it has a tendency just to shut down. This is something that we're also taught as audio engineers. It's the same thing in mixing. You can't have too much crazy complexity or people just tune out. So the reason why death metal is not a popular genre of music, whereas pop music is very popular. It's very simple. Keeping it simple is how our brain is able to spot repetition, and if we can recognize patterns, then we can act upon them. So in using MarketSpy and looking at it as a complete system is a way to get over how seeing it as being too complex, seeing this indicator spaghetti. People use that term. So an adept at using the collection of 5 strategies designed to be implemented with this comprehensive indicator package. And this is another important one attuned to taking profits on time using ATR in lieu of the traditional static risk and reward plan. So this is another really important aspect of trading with CR as our sensei, is showing us how to take profits on time using ATR, which is, as far as I've seen in the 2 years I've been trading, it is probably the most reliable method. It has the highest probability of kind of understanding what range the price is going to move in, and when you're consistently taking profits based on those values, then you're taking profits more than you're getting stopped out, and then it just stands to reason you're going to be consistently profitable when you consistently take profits. So And the last one's just a bit of a philosophical take. A spy acts upon information unavailable to their competitor. A market spy uses the tools at his or her disposal to notice maintenance or shifts in market structure. And that's kind of what we're looking at when we're looking at the EQ zones and where price is in relation to that. Is we're seeing if traders are deciding that price is fair, is it overvalued or is it undervalued, and that's basically what our EQ zones are attempting to tell us. We'll get into that a little more specifically. So, market thermodynamics. So, as market spies, we trade with the knowledge that price movements are not random. They're the result of agreements and disagreements between participants. Price fluctuation is ultimately the exchange of energy between participants. All movements are the result of causes. These causes are likely unknown to us, but they will always represent themselves through physics, the chosen language of energy. So we position ourselves to take advantage of the inefficiencies in delta and discrepancies between supply and demand. And I think that MarketSpy does a really good job of showing us where those areas are. We have a lot of different tools between DSR, Armageddon, and MSX to see those, and different strategies to take advantage of those discrepancies. So it's a total system. MarketSpy system is a complete package that provides entrances and exits, a take profit and stop loss. It gives us a general trading philosophy which you can base a trading plan upon, and it gives us risk management, which is pretty unparalleled. I haven't seen anything that comes close to BYBIT Pro's risk calculator. It's great. It shows you everything you need to know, and it can protect you from blowing your account up, which is what most new people are going to do at least once or twice. So this was a little screenshot of the trade data that I took from trading that I was doing after about 4 months. I had a 98.46 win ratio. I forget the website that gives you this information. Someone knows. Someone will know. But it gives you detailed stats when you plug in your exchange. But it's worth mentioning that even though my win rate was 98.46%, I was about profitable for 4 months, and then I still suffered, I think, like 2 catastrophic losses in a row, and then one for a little bit, and then another one that almost like decimated my account. So just it's something to keep in mind, that just having a high win ratio is not really what we're going for. Obviously, you need to have proper risk management in place. That's something that I didn't, and I learned the hard way. So, what it is not. MarketSpy is not a buy and sell indicator. If people are looking at it like that, they're overly simplifying what they've received, or they're expecting some kind of get rich quick scheme or some kind of like magic pill that's going to do all the work for them. Definitely isn't that. MarketSpy is not going to stop you from being a degen trader, like how I had a 98.5% win rate but still managed to wreck my account. MarketSpy will not master your psychology for you. You don't have to master your psychology if you learn how to sign your contract with the market by accepting your risk before you even put a trade on, and acknowledging that in your stop loss and how you've positioned yourself. MarketSpy won't turn off your phone notifications. It's not going to make you disciplined. This is on you. MarketSpy will not develop a trading plan for you, but it will give you strategies that are more successful than not. Executing and correctly interpreting the signals, it's on you. Shouldn't need to be said, but it does need to be said, because I think it's pretty common in this industry where you're going to find people who are just jumping in, and anybody can put on a winning trade. Anybody can find themselves in a winning trading position and then make $10,000 and feel like they can start doing this for a living. But it requires a lot more skills to be developed than just that. Okay, so the focus of the presentation here is going to be mostly on Armageddon. I find that most of the strategies rely on information that Armageddon is giving us, with kind of looking at certain checkpoints from MSX or DSR. But I find that the bulk of the action is in Armageddon because it's the overlay that goes on price action, and price is king. So Armageddon is a collection of moving averages creating EQ zones and a set of symbols indicating potential entrances based on specific strategies. So this is basically just a copy over from the starter guide at MarketSpy, but maybe you haven't clicked on that. We'll go through them anyway, just because understanding these symbols is very important. Understanding what they mean in relation to what else is going on in the chart is even more important. So, arcane entrances into occult price action. So the pod, the pre-order dot, the little green dot there that shows up underneath a candle. It shows up in the magnetic ribbon. It's shifting from blue to yellow, which is a bearish sign. In context, bullish, above baseline 1, and during a broader bullish market trend. Called pre-order dot, as this is where you look for pullbacks to buy or sell depending on market structure or pattern geometry. So it says it's a bearish sign, but oftentimes it's kind of a buy the dip kind of situation when you're ranging or trending upwards. If you're in a strong downtrend, if you're in a strong bearish market, then it's a different story. Again, all of these symbols need to have the greater context of what's happening in the market taken into account. If you didn't, then people would be able to create buy-sell indicators, but it's not that simple. Okay, the red diamond. So this is a mirror of the red C dots, the confirmation dots, crossover dots in MSX. They're displayed when the white momentum X wave on MSX crosses the blue momentum Y wave. Context. The dragon skin strategy is used to refer to these symbols as checkpoints. This is where you'd be looking to enter a trade expecting price to continue moving up if price is trending above at least baseline 1, and it's the first such signal. After a series of red diamonds, it's expected that trend exhaustion is increasing and we're due for a reversal. Bearish continuation signals during strong sell-offs. So I personally don't keep the red diamond on my chart, just there's enough stuff going on there already, but I am very much aware of the C dot crossings on MSX. If you're doing a dragon skin, which is it's a very profitable strategy in my opinion. It's waits for confirmation for the trend and then it just follows it up. It's pretty straightforward. Then having those on your chart could be very useful. If you're also keeping MSX up there, and you're aware of when the C dots are happening, I mean, obviously it's a matter of personal preference how much you want on your screen. Okay, the white diamonds. These print when a new lower low is found, momentum is bearish increasing. Confirmation sell signal, and usually occurs on sharp pullbacks. It gives plenty of time to analyze if the sell-off is worth paying attention to. Context. Pay attention to weekly and daily support levels and trade these closer to breakout points or after very strong legs up and a decent amount of sideways consolidation. Serves as one of the better buy signals during strong uptrends, as this is what bind the dip looks like. One would first wait to see if price finds support post-signal. So this is another one of those, and you're going to see this very commonly on your charts when you see white diamonds, yellow X's, and pyramids printing on single candles. Now, each one of these signals could be giving you conflicting information, but they're ultimately just saying different versions of the same thing. They're saying that there has been a massive decrease in the price. Maybe there was a supply influx. Maybe there was a lot of people smashing market buy and there wasn't a lot of price. There wasn't a lot of limit orders waiting in that area to take price, so price just jumps through them and hits the next order, which could be far underneath where that was. There's a lot of reasons why price can jump suddenly. It's a good idea to pay attention to volume when that's happening, but point being is that it may look like sometimes it's giving a conflicting signal, but once you understand what the symbols actually mean, you'll find that they're not conflicting. As the pyramid oftentimes looks like a buy signal, it's actually indicating that prices moved like down quite a bit away from the mean. The reason it seems like a buy signal is because it's moved away so far from that location that it is likely undervalued. So when you see these stacks, and we'll take a look at an example later on, but you'll see these stacks of symbols pop up, and people don't know which direction to choose. Chances are you're overly focusing on those symbols. You need to zoom out. Maybe you use multi-time frame analysis. That's what I do. I always have a higher time frame chart, generally scalping smaller time frames. But you have to be paying attention to the larger scale of things to understand what those symbols are trying to tell you in the larger context. All right, so next, the yellow X indicates a potential extension to the downside. Helps traders to avoid buying any pullback immediately after the candle closes with the symbol on. The context can be ignored when price is above baseline 1, but a baseline retest is expected, a short continuation signal under bearish trend conditions. So even in the explanation here, it does give you the context. And I think sometimes maybe people just kind of skim over these things a little bit too quickly, but you definitely are always taking the context of where you're seeing these prints in place to correctly interpret like what's going on. Hindsight's 20/20, of course. And as soon as you put that trade on, you're going to see symbols pop up, and you're going to interpret them in different ways because if you haven't properly signed your contract with the market and you're no longer emotionally invested in that trade, then you're going to reinterpret these things however the heck your emotional self wants to interpret it in order to minimize your pain or to hope that price moves where you want it to move, right? So the white X, momentum break on MSX, a fake out indicator, bids versus asks imbalance. Bearish, as most signals found at Armageddon. Context, a complete lack of power from buyers as price continually prints hidden bearish divergences upon attempting any climb up. Often marks last-minute sell-off before reversal to trap fear sellers. It is advised not to trade within a 5-10 candle range in order for volatility to cool off and a direction is established. High chance you'll get chopped up on up-down impulses. So the green stop square, a point of profit taking for those holding shorts. On the other hand, this is a short signal best entry point for a continuation if you're not already short. If you're performing, say, a like reverse dragon skin, then these are your yellow flags. The green stop square is going to be your entrances into a short position. Used to find best short entry continuation signals for the dragon skin trend continuation strategy. Think of these as the opposite of the yellow flags. They are checkpoints, best entries for short sellers. Context. Price must be below all baselines when initiating a short position on the green stop squares. Entry will reside inside EQ1 during strong downtrends. You're getting in on the pullback. Yellow flag. See the red diamonds and C dots. These are checkpoints, potential resting points before continuation. Points of entry in strong uptrending markets. Opposite of the green stop squares. Profit-taking signal for those who are long from the lows. Second chance entry for those who want to ride the momentum higher. Context. Great pullback points to watch on strong momentum acceleration. It is advised to exercise caution when you see a number of flags printed. Typically, 3 to 4 is when you want to reevaluate trend conditions. You will learn more when you actually use the supplied strategies. Red flag. Uh-oh, that's a red flag. Like yellow flags, but risk is higher as price is now trending below baseline 1 on overbought momentum. The context. Step back as it's going to get choppy. Risk is high and chances of a full reversal are increasing. Nothing is immediate. Waiting is how you win. Don't let them scare you, but start by being aware that these flags mean we have to be more we have more to be aware of. And the blue dot, this one I think is the most misinterpreted symbol and the most talked about symbol that prints on Armageddon. It's the Mag 7 preparation signal, used to set alerts only and highlights strong impulsive candles. Sets the stage for a potential Mag 7 setup. Context: MSX is the base for the strategy. It must be consulted first, not a buy signal. Blood Diamond is the opposite and must be used to assist with short setups. Part of the full Magnificent 7 strategy. We'll go into that more once we actually get to the Mag 7 strategy. And the pyramid, my personal favorite. Trend independent signal indicating a bearish pullback when price is trending below equilibrium zones. Excellent short signal during poor trends. Must be used within context of the market enemy strategies 1 and 2. Where the pyramid is an immediate buy signal during bullish trends, and an immediate sell signal during bearish trends for the market enemy type 2 setups. Used as an alert to prepare a bidding area below previous lows as per the market enemy type 1 strategy. Alright, so that's just a basic overview of the symbols. If anyone has any questions about that. And maybe some questions will pop up when we actually get into the strategies, and you might get a little bit more context as to what they mean. All right, we'll move right along here. All right, equilibrium zones. What are they? So this is EQ1. This is probably the most interesting, and I would say the most unique to MarketSpy is the EQ1. I think it uses a combination of a triple exponential moving average with a couple of other exponential moving averages following price more closely, and then the dragon ribbon itself is just comprised of a bunch of EMAs, but it creates again, emphasis on the idea that MarketSpy is a visual system. So just by kind of looking at a glance, it makes it a lot easier to spot if we're trending, if we're ranging, and sometimes you're going to have to swap out in time frames to notice these. But what's EQ1 here? You can see it's the zone that's created between the magnetic ribbon, baseline 1, baseline 2. Baseline 1 is the thicker green baseline that just changes from green to red. And then baseline 2, as long as you have trend optics turned on, or baseline optics, trend optics, I forget what it's called, but it's in your settings in Armageddon. That way baseline 2 and I think baseline 3 will change colors. Baseline 2 changes from red to white when it's neutral, and then it normally goes flat, and green in a bullish condition. Yeah, and when it flattens out like that, you'll find that it's baseline 2. It's almost like a magnet where it kind of price kind of has to return to that point, it seems, before either providing support or bouncing off. So what did I write here? 1 bounce, 2 bounce, fails in the third. So this was just a point where the trend had changed. We had lost baseline 1, and then it started to act as resistance. If you're following the traditional support flip resistance, which is kind of what the EQ zones, they use a lot of that aspect of that strategy. Then we lost the baseline completely, blasted right through it, blasted past all the previous lows, came back to test into the dragon skin, failed, and then dropped again. This would have been a perfect reverse dragon play. But yeah, that's EQ zone 1. Let's check out EQ zone 2. So this one's a little bit harder to see where it is, just because of the way that baseline 3 kind of jigs and jags around and then goes flat, just like baseline 2. But it gives you a lot of information, and when you start putting these things together, the amount of times that you watch them kind of act as like one-shot trampolines where price will bounce off of them and then kind of return to the trend. It's great for spotting these things. Each time you'll notice that one of the baselines cross over, it's another signal that momentum could be changing. It's kind of a matter of personal preference to see, like, are you going to wait till all three have crossed over? Do you wait until just DQ zone 2 does? As far as baseline 1 across, it depends on what time frame you're on. It follows price fairly closely, so if you're looking just at baseline 1 and Q zone 1 and that flipping from green to red and assuming that that means we're in a reversal, you're probably going to have to look for more confirmation. But then when it comes to EQ zone 2 and 3, these are much longer periods for the EMA. So even on a 15-minute time frame, it's going to have more weight than just EQ zone 1 flipping over. So you can see here, as soon as EQ2 flips over into the bearish, flips onto the underside of when baseline 4 crosses 3, that's pretty much, it consolidates for a little bit and then price drops down, comes back up, falls again, comes in to test EQ zone 2 almost perfectly, and then, whoops, how do I go back? Anyway, well, there's EQ zone 2, EQ zone 2. How do I use this? Like arrow keys? There we go. Yeah, so it just, when you put all three of these together, I'll show you what I mean in the last slide here, but the way that I look at it, I kind of consider each EQ zone to have like one life. Like you can bounce off of it once on a lower time frame. After that, I don't consider it as support anymore. I consider that's all of those orders to have been taken up. It's not always the case, but it's safer for me that way. Let's go to EQ zone 3. So this is the largest period. I was looking at it, and if you're looking at the 30-minute time frame, EQ zone 3, that lines up kind of to like the 4-hour EQ zone 1. So, well, I'll show you some examples of that later, but that's something that's really good to pay attention to if you're zoomed in and scalping, which I know a lot of people are drawn to and a lot of people do. Really keeping your context in mind and larger time frames in mind. Because if you're zoomed in and scalping and looking at EQ zone 3 and expecting this strong support or resistance from this area on a low time frame, it's just unrealistic. You need to be watching higher time frames and seeing that where EQ zone 3 is, it could also be where EQ zone 1 is on a 4-hour, and we could have already tapped that a few times and you just didn't notice that because you were too zoomed in. But you fairly reliably are going to get bounces off this level when it is in the classic like open alligator jaw of like the Williams alligator fractals and all those kinds of EMAs that are based on that same principle. When they're on an angle that is parallel and they're spaced apart, that's when the trend is strong, and that's when they're going to actually work as supports or resistances. And then once they flip, once the baseline 4 in this example is crossing over 3, then that's when it kind of turns bearish here, and then it provides the support again. And now let's look at all of them together, because that's how it's supposed to be looked at. So now you see them in this same price area. When all of them are put together, you can start to see how they all work kind of together as 3 different layers of support and resistance, like a dynamic version. You can go back and look as well at these zones, and like it's like 80-90% of the time they're going to line up with horizontal lines that you could draw on the chart yourself. It just seems to be a function of how price averages out, but go ahead and experiment. Like, check it out. Look how often it is that EQ zone 3, for example, ends up lining up with some other price point on the chart. It's pretty cool. So what do I got written here? So once EQ zones have been hit on a lower time frame, this for example is the 10-minute, they should be considered broken and no longer providing support. If you're also watching higher time frames, you will find that there is confluence there. You would also notice that lower time frame support might not even exist on a higher time frame. A common issue with being too zoomed in for too long. Scalpers beware. The dragon skin on the 4-hour may be the EQ3 on the 15-minute. I later checked and it lines up to the 30-minute. Spend some time watching multiple charts to see how they interpret the same information in different perspectives. All right, and then I just kind of drew my little interpretation of what was going on here in relation to the EQ zones. You probably play it close to dragon skin when you're paying a lot of attention to the EQ zones and what's going on. Obviously, you're going to want to enter at the best points where there's going to be the stop square, and then you're looking for it to kind of retrace into EQ zone 1 to find a good position, but we'll get into that when we get to the strategy. So yeah, almost every time dynamic support and resistance plots will line up with static horizontal lines that people draw on the chart. Higher time frames will always win out. Lower time frames will predict the move sooner. What is your goal with this trade? Do you want to be in possibly sooner and take the risk of perhaps receiving like noisy information that's not as filtered out by the test of time? That's kind of depends on your personality as a trader. EQ zones are always kept in mind when initiating and exiting trades in order to have context and know what the entrance signals are actually trying to tell us. This is one of the most overlooked concepts, and perhaps one of the more confusing because of the screen real estate it takes up and spaghetti factor. So I did kind of talk about that earlier. I think a huge part of getting to understand the MarketSpy trading system is knowing all of the moving parts and kind of why they're there. And it's a really good idea to go through them and like turn them off one at a time, and then kind of take a look at it and see how price reacts to those levels, and then kind of turn them on, like what I'd kind of shown with these slides in the EQ zones. Like, just mess around with it so that you can kind of see how price reacts to those different levels without having everything else in the way. Then when you put it all back together and you really kind of pay attention to it, it's not going to look as crazy. It's really great for spotting trends, but in a range, it's naturally going to look a lot messier because moving averages just don't perform that way in ranging markets. That's not really what they're designed to do. In that situation, looking at taking a closer look at MSX is probably going to be your better bet. All right, so the strategies, and this is back when I liked purple and blue candles. Ugh. All right, 5 strategies. So this is what we all signed up for, folks. So dragon skin, it's a trend following strategy suited to get you in when a trend is confirmed and retested. That's it. I personally think it's the simplest strategy. It's also one of the more reliable ones, in my opinion. Just because so many people are trend-based traders. So when you're following like a sheep, like the herd, it's gonna benefit you sometimes. Punch out, a breakout strategy using Elliott wave counts and a shift in market dynamics to get you in before or as the breakout happens. Fairly self-explanatory. It's a little bit more complicated though than a lot of the other strategies, as it does involve using a trend-based fib extension with the simplest of settings and then kind of waiting for that confirmation before you enter. Market enemy type 1, ME1, following smart money, using a laddered entry to enter on wicks at high probability, previous lows and highs. It catches reversal candles. Yeah, it's taking advantage of extremely overbought, extremely oversold areas where price spends almost no time in, because it is just exhausted. It's already moved so much, and you're kind of taking advantage of all of these panic sellers and buyers who are getting in right at the bottom or top, and then they're getting out of their position because they knew it was stupid. It's like these are events. The best market enemy trades, I find you're like immediately in profit. But you do have to spend some time on the charts to kind of catch these. Jackrabbit, the market enemy 2, power scalper. It performs better in ranging or kind of bullish territories. I myself haven't really found a way to make a shorting jackrabbit a reality. That's not that I don't take shorts. I actually short more than I'm long, but I just haven't really found a way to use that symbol and specifically find a good short. It just happens too quickly. Mag 7, Magnificent 7, the momentum identification uses confluence of many indicators to provide an entrance to a trend-setting movement. All right, without further ado, let's get into them. And again, like I said earlier, if anyone's got any questions or wants to add anything, feel free to speak up or to put it into the chat. All right, the dragon skin, find the trend and ride the dragon. So to me, this is kind of one of the simpler strategies to start off with, as it's something that you'll find in most people's way of trading, is finding a trend, getting into the trend, holding it for a time, getting out, getting your money. Identify the market conditions. You notice a trend, follow the trend. This is the most straightforward of strategies. It's the classic pullback. So any one of these pullback points is a great way to enter the market. And with Dragon Skin, we do have a specific method to do so. So we enter on the flag, one of these yellow flags that prints on the screen, and there'll be a break in the train. What we call the train is these yellow and gold diamonds underneath baseline 1, and they print when there's kind of a large enough distance between baseline 1 and baseline 2, and we get the train going. When there's a break in the train right after the flag, it's kind of that moment where suddenly that leg of that trend has had a pause. Buyers are exhausted or they're taking profits, and then price pulls back into the moving average, and that's kind of where we want to position ourselves, is in that pullback. Suitable to target a higher take profit and use discretion, exiting 90% at the first flag or sign of resistance. The example shown, where I drew my kind of long box here, I used the ATR method of taking profit. I just personally, I was day trading full time, and as soon as I started taking profit on ATR, I was always taking profit. That's why I wasn't losing a lot of trades, is because I would always take profit, and it also kind of instills this idea in you that you're consistent, like you're consistently taking profit day in, day out. It's psychologically, it's really helpful, I think, to continually take profit, set a stop loss at break even. All of a sudden, all of the stress of that trade's gone. Like you've already won. You don't have to think about it anymore. There's something that's really good about just being able to, like, you sign your contract with the market. Whatever happens after then, it's out of your hands and you've made your money. You're good to go. So you set your stop loss under the nearest untouched DQ zone or support. If it has been broken, perhaps choose the next DQ zone, deepen your entry. So in this example, I had seen that it had already pulled back into getting close to EQ zone 2. So I put my stop quite a bit further. I'm okay setting more like a 1.2 risk to reward because I have a higher hit rate. That's kind of the way that I prefer to do it. For a lot of people, it's more like a 2-to-1 and aim for like 60% win rate. Again, that's a trading plan thing. That's just all up to how you decide that you want to play the game. So I think a Dragon Skin is probably the simplest of the strategies. One thing I would notice here is it's not really a perfected trend. You can see that the other baselines are still correcting. You can see it clearly. This is just after probably a fairly strong downtrend, and it just recovered. Just looking at baseline, the simple moving averages, and baseline 4. So it's a little riskier when you're not dealing with a perfected trend, but this is the 10-minute time frame. So baselines 1 and 2 can still give you pretty consistent results when you're in those lower time frames, as long as you're watching the higher time frame and seeing what's going on, and you've got your stops in, and you've signed your contract. Right? You're good. Has anyone got any questions about the Dragon Skin strategy, about counterindications maybe, or maybe you had an experience where you thought you were in a Dragon Skin and then it didn't go your way, and maybe you need clarification on how the symbols print or anything? Yeah. All right. Well, yeah, it's pretty simple. Let's go through this stuff again. So this is what's on the official best time frames for Dragon Skin, riddled with puns. That is, it's a good question. It's, again, I'd hate to rely on this answer too much, but it's really depends on like what time frames do you find yourself trading in most of the time. Like, I don't know if you're trading every day, if you have a day job and you come back and you're looking at more kind of swing plays. It really, I think that the Dragon Skin performs on nearly any time frame. The difference being is that when you are on lower time frames, these big moves that, like these massive Darth Maul candles that seem to just come out of nowhere, they're going to surprise you, and you're going to have like very little indication. Yeah, you're going to have very little indication that these that of what caused that massive move. That's personally why I always keep 2 charts up. If I'm watching the 15-minute, then I'm also watching the 4-hour. If I'm watching the hourly chart, then I'm also watching the daily chart. I split them so that they're right beside each other. I don't want to be trading against prevailing trend or see a signal pop up on an hourly chart when I'm in on like the 6-minute chart and be completely unaware of it. So to answer your question, I don't think that there's a really a specific time frame the Dragon Skin performs best on. I think it works for almost anything. But if you're on the lower time frames and you're not keeping what's going on at the higher time frames in context, then you're going to get surprised. You just hope you have a stop loss in place, because that is how you find yourself in bad positions. So Box made a good point there. Maybe we'll kind of, if you got some questions, maybe write it down and keep it to the end, just so we can keep it as clean and concise as possible to pertaining to the strategies, and then we'll just answer them at the end, if that's cool. and we'll move right along here. So next up, we've got the punch out. This is a breakout strategy. I think CR had actually had like another name that he had taken it from. It's a fairly commonly known strategy in in other trading firms. If people actually work at professional trading desks, this is one of the strategies that they would use. So after a significant dump, preferably I think in the example used, you kind of count 3 Elliott waves through our Elliott wave simulation. So you'd see, like, if you're in a strong downtrend, say, you'd have a bunch of red candles, and then you might have a few shift from red to white, and then it has another leg down, and then if you see that happen again, like another shift from red to white, and then it jumps down again, and you have that third wave where candles had went from red to white, and then back to red, and after 3 of those waves, I think that constitutes like the most valid signal that you've actually completed that pattern. I could be wrong on that, but I do remember that there was something outlined specifically about the Elliott waves. So then on the first like candle that turns from white to green, I've got it outlined here in the picture, this little green box here. Then you will pull out the trend-based fib extension tool with only 1.5, 1, 0, and minus 0.5 selected, and that'll give you the zones. And then you wait until that candle closes, and then you're going to draw your trend-based fib extension on that candle, and then you wait for price to close above that area, and if it does, that is confirmation that we could be having a bit of a breakout or a movement up, and so that is when you would enter the position. Whether you enter in with a ladder encompassing the trend-based fib extension tool, or if you enter on a limit order, that is kind of a matter of personal preference. Myself, I'm a fan of ladders. I like to get something out of it, but at the same time not be kind of get the best price that I can, and I like the ladder for that. I think the general rule as well is to set a stop loss underneath the 0.5 point, a little bit underneath it. If price breaks below that, well then we're probably not breaking out. Of course, crypto moves quite crazily. You can easily have a wick come down and just whip you out of that order, but that's the nature of the beast. So you target the nearest resistance where you take profit, or use HER, which is my preference, and you seek confluence from DSR. So the best trades are always going to work out when you're kind of taking a look at our third opinion, dynamic support and resistance, and seeing if there's any confluence levels or things that you notice, like if DSR has been trending down consistently for a while, we're having the pivot points showing bearish days consistently, and then all of a sudden you show an outside pivot or an inside pivot, or like something changes, and you notice that the S1 and R1 zones are like now much wider than they were before, and the CPR is super tight, very thin. If you notice that, and you also notice that it looks as if buyers are taking control again, so that's going to be confluence that you're looking for from DSR, or other tools that you might use to identify key levels. I like DSR. So another key point, and again, you always have to keep in mind the context of what you're seeing these symbols print in. Like, I really can't stress that enough. And this is probably the thing that's the hardest to do while you're actually trading, because you don't have context. We don't generally stop and like take 10 minutes and go like take a walk and think about what we've seen and then come back, like because there's money on the table, or we feel like there's money on the table. But we really need to see the context of what the symbol is printed in and base our decision on that, not just because something flashes and a signal shows up and we think that means buy or sell, right? So what is the punch out telling you? Price has just fallen like for quite some time. It consolidated for a bit, and now perhaps it's ready to move back up. If that's the situation that we're in, you're seeing the EQs, the other EQ zones are starting to flatten out a bit. We're now above baseline 1. We've already had a reclaim and retest. Like, these are the kind of things that you look for, right? They're giving you confluence instead of just seeing that a candle has turned from white to green. That doesn't just mean that you throw your trend-based fib extension up and that's a punch out. Like, you might win that trade for sure. That could totally happen, but that doesn't necessarily mean that you're following the strategy as it's been outlined. And I think that's worth mentioning for all of the strategies. You can always put on a trade and it can be a winner, but are you following the trading system? Is it going to give you consistent results? Is this something that you can set by these parameters and sign your contract with the market, set your stop loss, and be comfortable, be able to sleep with that? Like that's what you want. You want to be have faith in the system and not lose any sleep over it, and that's what we're looking for. So yeah, punch out's a great strategy. It has a pretty high hit rate. It's not one that I personally use as much. I'm just it's just not something I have as much experience with, but I find that a lot of people like this strategy quite a bit because it does have a high hit rate. If you got any questions about the strategy, yeah, just take a note, write it down, and we'll get to that afterwards. But we will move on. All right, so market enemy type 1. This is a very profitable strategy. For myself, it's what drew me to this program in the first place. I spent a few months just learning this strategy alone. When you're using BYBIT Pro and you are able to use the ladders, it just it's a great strategy. And I don't know, there's some kind of magic in these pyramids. That's my belief. Okay, so it's seller exhaustion. Every time you see real great ME1s, there's almost always massive wicks somewhere nearby over to the left on your screen. So what are we doing here with the market enemy type 1? What are we targeting? What are we looking for? We're looking to move with market makers, moving with the smart money, so-called. Placing your bids where others are getting stopped out. Everyone else is having these cascading orders where they're already getting stopped out. And that's kind of where our ladders are sitting, with lots of room to breathe. So order placement is at areas of high interest for high probability bounces or rejections. We're entering in on wicks generally, taking profit on ATR, leaving 10% on the table as a runner. That is the philosophy that we teach here at MarketSpy, and it keeps you in the money. So yeah, it's my personal favorite. You feel like a ninja or sniper when you get these entries. So let's take a look at this one in the middle here. Price dips down. We got the pod and the pyramid print. You take a look over to the left. You see this massive wick kind of pointing down. I don't know if you guys can see my mouse cursor here or not, but yeah, you see this big wick here. Come over. There's another big huge wick over here, and you draw your long box down. Boom, you get filled about a third of those contracts. Price shoots right back up, and you'd be in great profit there. So for the most part, you want, again, like you played this after you had already seen a bounce. You'd already seen it bounce and made a higher high, and then it was coming back down to retest the baseline. It's not like it's heading straight down off a cliff and you have one of these signals print. Like price is obviously taking a pause here. That being said, you will often see a pyramid print right as price dives off a cliff, because in most situations, it's going to print. The pyramid's telling you that the price has taken a major divergence away from the mean, and that it can't tell you that price is going to go up right afterwards, but it will tell you that there is a higher probability that people are going to buy this and see it as a dip. I love this strategy. It's made me a lot of money. So, I think that an issue that people have when looking at any of the printing of these symbols is, again, it's just context. You're looking at the symbol and seeing it print, and you're not paying attention maybe to where the EQ zones are. You're not might not be paying attention to a higher time frame, and seeing how much pressure is coming from the other direction that you're just unaware of because you're too zoomed in. But for the most part, these symbols, the pyramids, are great. You're also going to come into a lot of situations where the pyramid prints and there's also going to be like a yellow X on top of it, or there's also going to be the red watch for Mag 7. And if you want to take your highest probability trades, you'll skip out on these because it's like stacking multiple symbols that are kind of telling you a very similar thing. But if I'm above baseline 1, it's pretty good odds that it's not just gonna like immediately jump off a cliff. You can probably catch 1, 2, 3 of these trades before having to worry about the continuation. It'll happen a lot. Like this was during a consolidation period after a dump, and you're gonna have profitable pyramids show up. But you can't play all of them. Like after you've played 2 or 3 of these, you should probably let it cool off, or maybe just one. Maybe you just enter one good trade. Like again, that's up to your trading plan. But if you like, eventually, you look kind of at the end of the trend here, or at the end of this consolidation period, you could still could have played this last one and profited off of it if you took profit quickly based on what that nearest resistance was. Yeah, I mean, market enemies, like myself, I spend a lot of time watching the 15-minute and the 6-minute, but I always have the like kind of 4-hour and daily chart up as well. I'm not going to be one who's going to say much about higher time frame swing trading style, and what these symbols mean in context to that, because that's not something I spend a lot of time in. I trust these symbols like generally. I trust them in lower time frames, in 6-minute, 15-minute, pyramids on the 3-minute. Honestly, I love them, but again, you have to keep higher time frames in mind when you're doing this, and have stop losses. You gotta understand where your exit point is. All my large losses have come from when I have entered generally market enemy style trades, but then not wanting to accept that it was now just the trend was just continuing downward and that I wasn't going to catch a bounce. So you want to avoid that, obviously. But yeah, I'll go into more about that later if someone has a question about time frame specifics. we'll move on here to the jackrabbit, what we like to call power scalping. So the way I see the what's happening here, you take advantage of a large supply influx, and you obtain the trading instrument at a discount within 1 to 3 candles. Honestly, preferably the next candle is when you see it reverse on the next candle. Like, to me, that's a jackrabbit, because it just seems to be how that strategy was intended to work out. It's more in kind of ranging or like slightly uptrending, small uptrends, and you see these pyramids print above baseline 1. To me, that's kind of like the best jackrabbit. If it's been 2, 3, 4 candles and you're not seeing the move happen after one of these pyramids print, you might want to kind of, I just get out. Better to be out when you're not sure why you entered that trade, or you're not sure if your interpretation of it was correct. It's kind of a quick in, quick out strategy. 1x position for the bold. It works well in identified ranges and small uptrends. You got to sign your contract with the market. Have a stop loss point. Be sure that this is not an ME1 setup, because it's going to react a lot differently if it's an ME1, the market ME1. You're expecting more of a pullback. You're expecting price to come down further into your ladder and eat up a portion of it or a chunk of it, and then reverse. The jackrabbit kind of comes to the point where the pyramid prints, and then generally it reverses like very quickly. If your stop loss is hit, consider this might have been an ME1 entry. Yeah, so just kind of watch out for that. Watch how many times the EQ zones have been tested. How many bounces have you already profited off of? So if you're scalping on smaller time frames, you got to set some kind of rule, some kind of system for yourself and your trading plan as to how many of these you're going to play before taking a break and like stepping away from the desk, taking a little walk, going and having a coffee or whatever, and coming back in 15 minutes, half an hour, to reset yourself. Because if you're staring at the chart for hours and you're waiting for these symbols and you haven't had any trades, but you've been sitting there for hours, you're going to start getting desperate. You're going to start seeing things that you want to see instead of seeing what's actually there with a more objective kind of frame of mind. So in the official channel in the top right corner here, we got what is written about it. We use the E pyramid trigger. We confirm momentum Z, that it's crossing, or that it, like, I kind of like when it's like stretched out all the way to the downside as well. It's another great sign that it's going to elastic back. So you confirm momentum Z is doing kind of what you would expect it to do when that symbol's printing, and you jackrabbit it entry with a limit or limit chase, and then you exit for 90% of the position identified and set. So that's already set. You already know where you're getting out before you've even entered your position, so that if it bounces out quickly, like your take profit's already there, you're going to take it, and you're not going to get you're not going to get the money taken from you from bots who are a lot faster than we are. You stop loss the remaining 10% identified and set. Repeat and profit. Personally, I set fairly, if I'm entering in a jackrabbit at like a 0.75, 0.5x or something like that, like fairly heavy position, I'm going to set my stop loss, and if I'm sure that this is kind of a jackrabbit like play, which I don't do a lot of right now because we're in kind of more ranging and kind of a bearish territory, I set a fairly tight stop loss. Like I'm not gonna be risking a whole lot. If it moves against that position, I'm gonna consider taking a look at it, and maybe there's an ME1 that I should have entered instead. Jackrabbits reverse like very quickly. From my experience, that's like, if what you were looking at was a jackrabbit, it's going to be the next candle, the next 2 or 3 candles, and if it hasn't, then you're probably something you're missing there. So yeah, again, this is another one that it's a fairly simple strategy, but you got to be bold with this one too, because you're um, it's recommended that you enter in like larger positions. Not we're not going over 1x here, but like 1x is a large position. That's your entire account. That's it's yeah, it's a serious entry. So again, yeah, if any questions about that and kind of how it. Yeah, yeah, I'll answer that at the end. Again, here we're almost there, but that's a pretty common question. Um, yeah, and just more kind of like, again, you got to look at the context of market conditions. And in this example, I actually turned off all the other, like I turned off the dragon scan, I turned off some of the other simple moving averages just to really focus in on what I need for jackrabbits, if that's what I'm looking for. Um, yeah, we'll get to that at the end here. All right, the Mag 7. This is a great strategy. A lot of people love it. Um, it's a great confirmation of momentum shift. So all the indicators point to a shift in momentum. The C bars and VVS light up together. The long-term trend flow is changing. RSI is up. Money flow index is up. Delta is up or is crossing. The momentum wave is printing a C dot. So the main issue that people have with this strategy, they're looking at this little blue dot that prints an Armageddon, and they say, great, Meg 7, enter in, and then price reverses immediately against them and stops them out. When all of these 7 indicators are pointing up, and we're already heavily oversold, if everything's pointing up and we're already we're overbought, sorry, when everything's already overbought and you have one of these blue dots print, everything's pointing up. That's what that blue dot's telling you. That's it. That's the only, like, it's not a complex AI. It's just telling you that all of these are pointing up. It's a great little signal and it's great to use for alerts, but you need to understand the context of where it's printed. So in this example that I used here, we had just been dumping for a while, for quite a while, and price had made a couple weak attempts. This is a forex chart, and hadn't done anything. And after it had dumped for a while and then reclaimed baseline 1, made a retest, then it printed. It didn't print kind of in some random area, or when like we were at the top of a range and then you see a mag 7 print. Like, that's not a mag 7. That's just telling you that all of the indicators are pointing up, and if you're in a range, well, honestly, it's probably more of a short signal at that point, because it's telling you that everything is overbought at that point. But when we're down in the bottom in a trough, when we've been selling off for a while, and then you get all of these agreements that price is going up, like, it's a really reliable symbol in those situations, and oftentimes marks like a major shift in momentum, or just a short profit take. It depends on how you trade, but this is a great strategy. Um, it waits for confirmation. Like, it generally is not going to get faked out. The main issue that you just really got to watch out for is the context of the price action before this symbol prints. Like, you really got to zoom out and take a look at what price has been doing beforehand, and it's valid when we've had a sell-off and then a consolidation and then we get a print, or if we've been in an uptrend and then it's had its pullback and it's consolidated for a while and then you get a print. Like, those are two situations where it's great. Like, it's great at identifying continuation in the trend after we've had the pullback and consolidated, and it's great after we've had a dump and then consolidate for a while, and then you see it print. Those are the times when I'm going to take one of these trades. Uh, Otherwise, if those conditions aren't met, I'm generally just ignoring those dots, or I'm taking a look at what else is happening, and when they show up, I might be shorting them, because it's going to be showing you that in a lot of situations, just that we were really overbought. If you look at MSX and everything's overbought and we're not, like, it hasn't just consolidated. Yeah, like you really have to keep context in mind when you're looking at these. Again, that's why I pointed out it's not a buy-sell indicator. Like you need to look at the context of when and why these symbols are printing, and really take that into account. And then it's gonna pay off for you, for sure. Yeah, but it's pretty simple. It's a simple strategy, but you just really have to keep in mind the context of why and when these are printing, and also double check. Like sometimes this blue dot will print, but like VVS won't be bright blue, and the C bars might not be lined up or something. Like sometimes it might have just caught 6 of the indicators, and it wasn't quite lined up. Like the strongest ones happen when they're all lined up at the right time, when the conditions are right. Like that's then I'm definitely taking this trade. Yeah, if you got any questions about the Mag 7, I know a lot of people do a lot of times, so just hold on to that for a moment, and then we'll kind of have a little period at the end where we can go through some of these again and with questions. Okay, so here's just kind of my general philosophy I put together. I haven't read this again, so let's see what I got here. Okay, execution requires more than just a strategy. Money management is still king. Each strategy is designed to take advantage of different market conditions in different ways. Identify the environment for the month, the week, the day. Base your directional bias in concordance with the larger trend for the safest positioning. Then start looking at what's happening. Signals without context will mislead you. A key aspect of the MarketSpy philosophy is an understanding, which means to stand under the authority of, average true range, ATR. Taking profit consistently on ATR means you consistently are in profit on a daily basis. We focus on intraday plays, using dynamic support and resistance to identify key levels of general interest, and then use ARMA and MSX to spot entries at those areas of confluence. Realize, don't analyze. We don't make assumptions or guess at what is happening. We see it as a matter of physics. Everything works as cyclical functions. Trading is based on mass psychology, so it's no different. The MarketSpy trading system uses visual cues to give us an idea of what the market is doing, so what people are doing, and provides specific points where we consider the context the signal is given and act upon it. That's it. No need to overcomplicate it. It is complete within itself. You identify the greater context, you see what the microcosm is representing in relation to that, and you enter the market or stay your hand. In itself, it is a simple endeavor, but we are complex, and so we project that complexity. Indefinite edge, order execution done right. Another advantage of the MarketSpy system is our order execution method, namely BYBIT Pro. Many traders fail within the range. MarketSpy traders using BYBIT Pro welcome the range. BYBIT Pro risk calculator syncs with your BYBIT account to know exactly how much you can risk if your stop loss is hit. Utilize multiple take profit points and automated stop loss to break even after take profit points. BYBIT Pro gives you algorithmic speed with a human touch. So even if you aren't using BYBIT, so you can't use BYBIT Pro, it would be wise to try it out. You can take the philosophy and approach that you discover through it and translate that style of order execution into other platforms. I personally feel naked trading without it, but BYBIT doesn't offer Forex or any of the other stocks, so I oftentimes have to. So in conclusion, more than just an indicator package, it's a trading system. Trading is simply enter, exit, increase, or decrease. Its method is as simple as it gets, but how one arrives at a conclusion to initiate an entrance or decide upon an exit gets ridiculously complicated. The MarketSpy system is designed to simplify that process by providing 5 strategies for seeking entrances that have inbuilt methods of taking profit and obvious visual cues for exits. It's a visual trading system. It is colorful, and each of its parts has meanings in relation to each other part. None of it says buy or sell, but each signal must have the context upon where it is printed taken into account. And that's all I got.